Good afternoon, everyone. This is the December 15th, 2020 meeting of the City Finance Committee. May I have a roll call, please?
Yes, Committee Member Gutierrez. I'm not hearing Committee Member Gutierrez. Committee Member Harmon.
Here.
And Committee Chair Friedman.
Here. Thank you. We do have a quorum. So next I will go to public comment for any items not on the agenda today that are under our purview. Are there any members of the public who wish to speak to items not on the agenda?
Chair Friedman, I am monitoring public comments and I'm not seeing any hands raised.
Okay, thank you. So I will close public comment and now we will move on, Mr. DiMartini, to item 1, which is the Statement of Investment Policy and Designation of Investment Authority for fiscal year 21. And I will turn it over to you, Mr. DiMartini.
Okay, excellent. Thank you so much, Chair Friedman. Good afternoon, committee members. My name is Keith DiMartini. I'm your Finance Director, and I'm here this afternoon along with our Treasury and Finance Analyst, Mr. Salvatore Parilla, who will be presenting many of the slides along with me today. And it's our pleasure to present the annual investment policy overview for fiscal year 2021. Next slide, please. The agenda for this afternoon's presentation is as follows. We're going to give you just a brief background of the city's investment policy and the rules and regulations around how we can invest the city's funds. We'll provide the scope and purpose of the investment policy. We'll talk about the objectives. We will also describe the staff recommended changes that are being presented to you this afternoon. We'll also give you some additional information about the current investment environment with some obvious challenges that many cities across the country really are having with just sort of atypical returns that we would normally not see, but are currently seeing, in some of the sort of restrictions that we have at this time. Next slide, please. So just to give some background, there are very sort of strict regulations and code requirements as to how municipalities, particularly in California, can invest city public funds. It's all governed by Government Code 53600. Basically establishes procedures and guidelines that ensures prudent management of public agency funds. Next slide, please. This slide gives pretty much the verbatim section of the Government Code. And I just want to highlight a few items in this section that are really important for the governance structure for the city of Santa Barbara and the work that we do in finance to invest the city's funds. We act as trustees, therefore as fiduciaries, and we follow what's called the Prudent Investor Standard guidelines. This basically says that staff that assist and manage the city's investment portfolio shall act with care, skill, prudence, and diligence. And by far the most important objective of managing the city's investment policy is to safeguard the principal and to maintain the liquidity needs of the agency. It's not about making the most return on the financial resources that we have. That is not the most significant objective. It's to make sure that we retain that principal and that we have adequate funds that are liquid in order to meet our needs. So we need to make sure that we make payroll every 2 weeks. We need to make sure that we pay our vendors. We need to make sure that we pay our debt service payments. So we have to have cash on hand and manage so that we can make those payments with no problem. So that is the strategy that we use here and that many cities use as well. Next slide, please. So just a little bit more background about our investment policy. State law doesn't necessarily require us. It does not require us to adopt an annual policy, but it definitely is a government best practice for us to do so because some cities have some unique situations with the amount of funding they have or where it comes from. And we have done that, which is a great thing that the city has done. So staff has recommended an annual adoption of the policy, which the council adopts. It incorporates any changes that may occur during the year that are statutory or administrative in nature. And then we submit that policy to the city council for your review and approval. And that is what we are doing today. It's important to note that our investment policy is actually more restrictive than what the state code allows for. And that again is along the lines of the prudent investor policy, really making sure that we are ensuring that our principal is kept safe and secure. Next slide, please. The scope of the policy really is about a few main topics. Number one, which is important to know, is that we pool our funds. So as council is aware, the committee members are aware, we have many different ways in which cash comes into the city. People pay their water bill, their wastewater bill. We have general fund tax revenues. People sign up for a program at Park and Rec. Those are all examples of ways that cash come into the city, but they're all recorded in different funds for different purposes. In order to achieve maximum investment earnings over time and manage our cash more strategically, we're able to pool all those funds together and then manage our investment portfolio thereafter. We're able to achieve a much greater return on our investments with that strategy, and it allows for much better management. Some funds that are excluded from the policy are bond proceeds, but largely most city funds are included in the scope of the city's investment policy. Next slide, please. This slide just speaks again to the objectives that the city is meeting through the implementation of its investment policy. Again, focusing on safety and liquidity of the assets that we have, but then also trying to gain as much yield, as much interest earnings as possible. And again, we hold our investments to maturity to the extent possible. We very rarely would like to call or sell an investment prior to its maturity date. Next slide, please. The investment policy does lay out the roles and responsibilities of some key city staff as it relates to the management of our investment portfolio. And so I wanted to make sure that the committee members were clear as to how the public funds in Santa Barbara are managed. First and foremost, the city administrator has the city council's delegation to invest city funds. The city administrator has delegated the responsibility of the program management, sort of the overarching program management of the investment portfolio and ensuring that the city complies with the investment policy to the finance director, to myself. In the finance department, we have a treasury manager, and the treasury manager conducts investment related activities. So that individual and the team under that individual will monitor our investment portfolio on a day-to-day basis, prepare reports, review investments that might be maturing soon, consider what investments to purchase if some of them are coming due, managing our cash flow needs, and activities like that. And there is a dedicated finance analyst, it's Mr. Parilla, who's on this presentation today. He has been the primary person that manages and does those day-to-day transactions and monitoring activities. And so from my perspective, we have a great deal of internal controls already in place with the management of our investment portfolio. Staff are trained and are capable of doing the work. We are held accountable through the reporting that we do on a frequent basis with the city council. So the public is aware of how our funds are being invested. So we have a very solid program in place currently. And so with that, as a transition, I would like to turn it over to Mr. Parilla, who will deliver the remaining slides.
Thanks, Mr. DeMartini. Good afternoon, Committee Chair Friedman, committee members, Gutierrez, and Harmon. My name is Salvatore Parilla, finance analyst at the City of Santa Barbara. To segue on what Mr. DeMartini mentioned about the importance of the investment policy for the city to serve as a guidebook to invest the public funds of the city. The primary purpose is to establish valid and solid guidelines so that when we make an investment decision, we know and look at the rules that we need to abide by. One example is the investment policy establishes a maximum maturity of 5 years and a portfolio average maturity of 2.5 years. That serves the purpose of helping reduce the duration risk and maximize investment return. Next slide, please. Based on the Prudence Investor Standard, what the investment policy also guide us to do is to make sure that potential conflicts of interests are avoided, and also to make sure that the authority that is delegated by council to staff is strictly followed. Next slide, please. The reporting portion of the investment policy is very important. That ensures that when funds are invested, there is maximum transparency. Therefore, the City of Santa Barbara issues a monthly investment report to City Council for approval, followed by a semi-annual investment report to Finance Committee and Council as well. In addition to those two requirements, there is an annual statement of investment policy, which is what we're doing today. Next slide, please. Going to the policy changes for fiscal year 2021, there were the recommended changes by staff are substantially four. So the first one is to add the supranational obligations to the list of the authorized investments. Supranational obligations are, in a nutshell, debt issued by organizations that are under the umbrella of the World Bank. The World Bank is the main backer of the World Bank is the United States government. The second policy change the staff is recommending is to add the public bank obligations to the list of the authorized investment. Back in October, the state of California passed a law to allow public agencies to form banks that are backed by public funds. There has been talk of a public bank to be formed by the state of California. So this addition gives the city an option to invest in the future in obligations issued by public banks as well. Moving to the third policy change for 2021, there's a change of the limit of commercial paper from 25% to 40% of investable assets that the city qualifies, given that we have over $100 million in assets. So we're able to increase from 25% to 40% of our investable assets, the amount of that amount to be invested in potentially in commercial paper. And it gives us an additional option to navigate ever-changing markets. And lastly, there's an option to invest in zero or negative interest yielding U.S. government obligations. This is actually very particular because it reflects the current interest rate environment and the current economic situation as well. As we know, negative rates are already in effect in Japan and in the European Union. The Federal Reserve here in the United States expressly stated that they don't want to go there. They do not want to go to negative interest rates. However, there's only so much that they can control. So the possibility of negative interest rates in the United States is not to be discounted in the future. So this addition to our investment policy gives us the option to invest, of course, in United States treasuries, even if they might yield a negative interest. And it all goes back to the importance of safety first, as far as investing public funds. Just to just a note for the last two policy changes. They sunset on January 1st, 2026. And the reason being is that there is a hope that, after coronavirus and, the pandemic economic damage, that, in 5 or 6 years, there is not going to be a need to have that option on board. Next slide, please. Moving on to the current interest rate environment. As we all know, back in March, the Federal Reserve took bold action to counter the economic damage caused by the pandemic. Therefore, we went from a federal funds rate of 1.5% straight to 0. And we're staying there. The Federal Reserve Chairman Powell, he expressly stated that the Federal Reserve is there to keep rates lower for longer, to make sure that the economic recovery is on a solid foot. Therefore, we're seeing interest rates at 0, rock bottom right now, and the reason being is that having low interest rates avoids illiquidity in the market, so it helps with liquidity flows. It pretty much helps with lowering the unemployment, which is very high right now in the United States, and also it counters deflationary risks. Next slide, please. And this slide gives you a snapshot of the City of Santa Barbara's portfolio as of the end of October. As you can see, the portfolio is well diversified. You can see that we invest funds in federal agencies, in the state of California Local Agency Investment Fund, some corporate notes in our portfolio. And if we go to the next slide, we can actually see a visual of the portfolio. This is, again, the visual. As you can see, we abide by our diversification mission. And that's very important to protect the principal and also enhance investment returns. Next slide, please. On this chart, you can actually see the performance of the city's portfolio compared to two benchmarks, the LAIF and the 2-year Treasury note. The city's portfolio is the blue line, while the LAIF rate is the green and the 2-year Treasury is the red. As you can see, the blue line is steadier than the other two. And the main reason for that is that our investment horizon of 5 years allows us to smooth market volatility, and therefore the moves in our performance are steadier than LAIF or the 2-year Treasury note. Next slide, please. This table is to show in dollar figures what the interest income generated by the portfolio is. Here, we just included the major funds of the city based on their cash balances. But as you can see, for example, for the for the fiscal year 21 to date, the total interest earned with those within those major funds, like the wastewater, water fund, the waterfront, totals slightly over $800,000. If we were to include all funds, that figure would raise to over $900,000. Next slide, please. And that concludes the presentation with the recommendation that Finance Committee recommend the Council adopt by reading of title only a resolution of the Council of the City of Santa Barbara adopting the investment policy for the city and assigning resolution number 19-066. And now I'm happy to answer any questions.
Thank you, Mr. Priya. So I will open it up to my colleagues for questions. I see your camera's on, Councilmember Harmon.
Thank you, Chair Friedman. Yes, just one quick one. I really appreciate this review, Mr. Priya. I think I noticed on one of the slides you mentioned that one of the recommended changes for 2021 is to allow us to invest in opportunities for public banking. And that's something that I know Chair Friedman and I agree on this issue. We're both really excited about the potential, its transformative potential to change our community. Do you see any opportunities to make that kind of investment on the horizon, or is this simply setting the stage for maybe in a couple of years when we'll have the chance? I'm just curious if you've sort of heard of anything that we'll be able to actively move in that direction. Speaking for myself, it's something I'm really excited about and I think has a lot of potential for us.
Thanks for the question, Committee Member Harmon. So we are at the beginning. The reality is that after the law passed in October, now the understanding is that the state of California is gearing up to, set the stage for something that looks like a public bank. But honestly, we're only in the seminal stage here. So I don't have a timeline on specific, deadlines to form a public bank here in California. But again, it is an option that, my understanding, it's an option that agencies, local and at a state level, will have to, put public funds to work for causes, for example, affordable housing and infrastructure projects and so forth.
That's awesome. Well, thank you so much. I realize that question was a bit out of scope, but I'm so excited to see that on there. And I really appreciate that you guys were so thoughtful in including that. It just really makes my day. So thank you.
Thank you.
Excellent question. We've talked about that before, and it's something, and I'm excited to see that we're setting the stage so that when it can come forward. I do have a question as well on slide 16. I'm gonna pull that up. It has to do with the portfolio rate versus benchmarks. You mentioned that our portfolio doesn't have the volatility, so it's performing a little bit better than the 2-year Treasury and the LAIF because we have that 5-year window. So what is that going to be like a couple of years from now? Because I assume that as we're investing now, we're going to start getting those lower returns because of the interest rates, and we're kind of locked in. So would we be expected to underperform later, or how does that work later on when we have more of these securities now that are performing lower in our portfolio?
Well, Committee Chair Friedman, thanks for the question. So the expectation is that low or rock bottom rates as we have now are not going to last for much longer. The economic forecast is that once the pandemic is behind us, then the economic activity will prompt the Federal Reserve to raise rates accordingly at one point to reflect the economic conditions. Now, in our case, in the case of the investment portfolio, we buy into market. As of now, for example, our tactical strategy or our tactical position is to leverage, the interest rates that we are earning in our liquid funds, for example, in our checking account, to, in a sense, wait and see, where the interest rate environment is shifting towards. Nonetheless, that's a valid question. Again, the performance of the portfolio strictly follows also the duration that we put on a portfolio. So in a nutshell, as of now, we're not really focusing on investing on the 5-year term to lock in very low rates, but we're looking mostly at shorter term, 2 to 3 years, so that we give ourselves the option to pick up some yield once rates start moving up again.
So that's how we hedge against these low rates now, as we invest shorter versus a few years ago, we could invest for 5 years because the rates were higher. But the strategy we have now is to do shorter term investments. And that's my question. I just was curious about that. I don't have any other questions. I don't see Councilmember Gutierrez, who is with us now. I don't see any camera on. So there you are. Do you have any questions, Councilmember Gutierrez?
No questions, but thank you for this wonderful information.
So I will open it up to any public comment on this item. Is there any public comment?
Chair Friedman, I am monitoring public comments and I'm not seeing any hands raised.
Thank you. I'll close public comment. And again, thank you for this report and for all you're doing to mitigate what we can in terms of the low interest environment that we're in, and appreciate all the hard work you're putting into it. So I will close this item and move on to item 2, which is the comprehensive annual financial report. I'll turn that over to you, Mr. DiMartini.
Chair Freeman, did you want to take a motion on that item, or do you want to do it at the end?
Oh, I'm sorry. For some reason, I thought it was informational, but it is a motion. So my mistake there. So is there a motion to recommend that the full council adopt this and forward this onto the council? Staff recommendation.
I'll make the motion to adopt and recommend to council.
Okay, there's been a motion for a staff recommendation, and there's been a second by Councilmember Harmon. Can we have a roll call vote, please?
Yes, and so there was a motion to approve by Committee Member Gutierrez and a seconded by Committee Member Harmon, and the motion is on the table for the adoption of a resolution of the city's investment policy for the city and resending resolution number 19-066. Take a roll call. Committee Member Gutierrez.
Aye.
Committee Member Harmon.
Yes.
And Committee Chair Friedman.
Yes.
The motion passed 3-0.
Great, passing unanimously. My apologies on the vote. I'm so excited to get to the CAFR because it's this is my favorite report of the year coming up from finance. There's so much great information in it. So now I will turn it over to you, Mr. DiMartini, for the CAFR.
Okay, excellent. Thank you so much, Committee Chair Freeman. Again, my name is Keith DiMartini. I'm your Finance Director. It's my pleasure to present, along with my colleagues, Mr. Mark Sewell, the city's accounting manager, and then also the city's audit partner, Mr. Nitil Patel from Clifton Larson Allen, LLC. The three of us are very happy to be here this afternoon to present an overview of the city's comprehensive annual financial report. It's better known as the CAFR, for fiscal year ending June 30th of 2020. Next slide, please. So the presentation outline will go as follows. I'll provide just a little bit of a background as to why we have to produce this very long, detailed technical report and why it's important and valuable. Talk about some of the layout and contents of the report. I'll turn it over to Mr. Sewell, who will present a majority of the financial highlights for fiscal year ending 2020. And then we'll turn it over to our audit partner, who will provide an overview of the audit results. And then I'll wrap it up, and then we'll be happy to take some questions from the public and from the committee. Next slide, please. So next slide, please. I'd like to give just a brief background as to what is this document? What is this CAFR? The CAFR, again, it's the city's annual financial report, and it's prepared in accordance with generally accepted accounting principles that are known as GAAP. And basically what it does is it presents the financial condition of the city at a point in time, and it details out the results of the operations of the city as a whole. And it's delineated into multiple different slices and dices of information. And I'll go into that in a little more detail in the next slide. But it is comprehensive. It is very comprehensive because it includes information that may not be typically found in any other document produced by the city. And it meets very, very strict and challenging best practice standards for municipalities that present financial information. And it qualifies for the Government Financial Officers Association, the GFOA's award program. I'm happy to report that the city has received the award, which I'll go into in the next few slides. Next slide, please. So the background, why is the CAFR prepared? Well, the first answer to that question, there are multiple, is that the city charter requires it. The city charter requires that that staff produces this report, and that our financials are independently audited by a licensed CPA firm. It's also required by state law. The CAFR is also a required document when and if we ever choose to issue or refinance bonds or debt, which the city has done and will continue to do for priority capital and other types of projects. It's a required document in order to be able to do that. And probably, in my opinion, one of the most important reasons why staff focus so much time and energy on producing a CAFR that is accurate and complete and transparent to the public and to the city council is because it's one of the many ways that staff can communicate to the public about what we do in the city. There are so many things that the city does and how the city chooses to prioritize and spend its resources and its money. And all of that information is summarized in the CAFR. And so it's a really, really important mechanism and vehicle and tool that allows us to do so. Next slide, please. I mentioned earlier about the GFOA award. There is an award program that many municipalities participate in. It's the Certificate of Achievement for Excellence in Financial Reporting. And really the main purpose of this award program is to encourage transparency and accountability and presenting information in a way that is consumable and understandable by the public, that people can use for different purposes to understand what goes on in that city. And I'm happy to report that the city of Santa Barbara has received this award for the 32nd year for its production of the CAFR last fiscal year. And we have met the criteria, but we believe for this current CAFR to go ahead and submit for the program as well. This again just reiterates the commitment that staff has at the direction of the City Council to continue to produce this document in a way that is very transparent and holding us all accountable. We will continue to focus on this document. So moving on to the next slide, please. I just want to give a quick overview of the layout and the contents. There's an introductory section in the CAFR which lays out a transmittal letter and information about the city organization. There's an independent auditor section and report from our auditor. Then there's a more detailed narrative. It's called the Management Discussion and Analysis, or better known as the MD&A. And that provides a lot of context about what's going on in the city during that fiscal year, some of the challenges that we have, some of the major projects that have been going on, economic factors that sort of influence or sort of impact the operations of the city. And then there's a series of financial statements, lots of numbers on pages, but a lot of financial statements. And then almost more important than the statements themselves are the notes. At the very end of the document are the notes to the statements, which describe and provide context for the numbers in the financial statements themselves. And then there are some interesting and informative statistical reports and trends of data. For example, demographic data, assessed value data, things that, again, add some context to the numbers. Moving on to the next slide, please. I will just give a couple, provide a couple slides on financial highlights. Next slide, please. So the document is broken up into a couple different sections. There is an overarching government-wide statement section. And that section is comprised of multiple funds. The most substantial portion of that category is the city's general fund, which is one of the largest funds in the city. We also include the Measure C, the district sales tax measure that was approved a couple of years ago. The Measure C activity is rolled up under government-wide financial statements. And then there are enterprise funds and other funds, such as our self-insurance funds or our other post-employment benefit funds. Those are sort of underneath different categories of funds in the CAFR. Next slide, please. So we've already talked about the different funds already. There are government funds, special revenue funds that have some special restrictions, like grant funds are included in that category. Then there are proprietary funds, internal service funds, and agency funds. And we'll go into some detail about some of the highlights on those funds for this CAFR as well. Next slide, please. So just a quick highlighted slide on COVID, on how COVID has impacted some of our operations and how it has transpired and reported in the CAFR itself. Clearly, there were significant impacts to the city's budget during the 4 months from when COVID first began through the end of June 30th. The city experienced a significant loss of revenue directly and indirectly from COVID, most particularly with sales tax revenue, our transient occupancy tax revenue, many department level types of revenues, such as our parks and recreation program revenues. The library had to close. There were many other revenue sources that were impacted due to COVID. There were also some expenditure savings because we weren't able to sort of have business as usual and perform our normal operations. We cut back on our expenditures as well. There was limited external relief in fiscal year 20 that is realized and booked in the CAFR. There was $4.5 million of CARES Act relief funds. And then for the airport specifically, there was $9.5 million of the Federal Aviation Administration, FAA funds that went to the airport directly. We have an active declaration of emergency, and we have a process with FEMA and Cal OES for disaster relief support as well. So that the transactions and the activity related to COVID are summarized here and are included in the CAFR through June 30th. And so with that, I'm going to go ahead and turn it over to the accounting manager, Mr. Mark Sewell, who will present an overview of the financial statements.
Thank you, Mr. DiMartini. So I get the joy of showing you pages with lots of numbers. I'll do my best to try to pull out some of the highlights there. And as Mr. DiMartini said, this document is, how many pages is it? It's over nearly 200 pages. It's available online from the city's website, santabarbaraca.gov/CAFR. And it is there along with a number of CAFRs for the last about 20 years. Should anyone run out of reading, there's plenty here to read. So next slide, please. What I wanted to start with was the overall picture. This is the net position of the city, and it includes all funds. And the net position is the difference between the total value of assets and total value of liabilities. And so if I draw your attention to the bottom right-hand corner first, the city's net position is $837.5 million. That actually is an improvement from the prior year, has increased a little bit, which is somewhat to show how well the city was really doing before the COVID impacts hit towards the last quarter of the fiscal year. And it's broken down on this slide in terms of governmental activities and business type activities are the categories that the finance director previously mentioned. So governmental activities has a net position of 345 million, and actually the largest portion of the city is the sum of all of business type activities, and that will be obviously things like water, wastewater, airport, waterfront, golf, downtown parking, those types of things. So total assets, 1.447 billion. The majority of that are capital assets. You know, the city owns a lot of facilities and lands and plant machinery, and you see that reflected in the totals here. Next slide, please. Statement of activities. This is another way of saying profit and loss account or income statement if you wanted to think about it from a private sector standpoint. And one of the things the comprehensive annual financial report requirements tell us is to show governmental functions separate from the business type functions, and also to then break them down into the types of activities that the government performs. And so you can see here, we break them down into administration, public safety, public works, community services, and development. So community services would include like the library and the parks and recreation departments. Public works will of course be things like the streets and engineering. And then public safety, fire and police. Administration is pretty much attorneys, finance, city administrator's office, city clerk, all that kind of stuff. And then of course, community development is community development. And so you can see here that for the year, the expenses totaled $194 million. And there was a portion of revenue received for a number of the revenue generating activities that those functions produce. Some of these functions produce fee paying output. For example, Park and Recreation offer recreational programs and facility rentals and the like. And so, as is intended and as is fairly standard across most municipalities, the actual costs of these operations are subsidized, and that's why you see on that far right column there, that's subsidized by general taxations and other revenues. And so the net difference between the functional revenues and functional expenses for the year was $126.9 million. And you can see that that was actually funded through taxes, general taxes, and this would be where you would see your sales tax, property tax, Measure C, all those types of different taxes coming through, $119 million, as well as some franchise fees and investment returns and all those types of things in the next column there of the 16.9 million, for a total 136 million. And when you add it all up together and take the start position and the end position, actually government activities, the net position grew by just over $9 million in the fiscal year. And again, that would have been better had it not been for COVID, because of course there was 3.5 months of the year where there was a significant impact to revenues. Next slide, please. Moving on, same type of thing here, but now what we're looking at are the proprietary funds or enterprise funds. You can use those words interchangeably. And you can see here a slight difference in that the revenues and expenditures are far closer together. And that's because these operations, these functions and programs do not receive any general taxation support whatsoever to fund their expenses. And so therefore, they're looking to break even in the long run. And so water, of course, is the largest enterprise fund at $50 million in expenses, and it generated $60 million in revenue, therefore netting $10 million. And the total for all of these, again, you can see down on the business type activities, was actually a slight excess of revenue over expenditures of 2.5 million when you look at the operating revenues and operating expenses. And there are some swings and roundabouts in there. And of course, some of these funds were more heavily impacted by the COVID pandemic than others. And it will be the challenge going forward to manage them through with their individual unique characteristics as we look to kind of come through and hopefully grow stronger with the the good news recently of vaccines and hopefully some economic recovery to come. The thing I want to point out here, there's a rather large number, which is a kind of, don't see this normally in a typical year in the other income line. You can see there's over $28 million there in that line. This is reflective of two kind of one-off revenues that came in. 19 million of that reflects a settlement that the Water Fund received as a result of some challenges with the Southern California Edison and Thomas Fire. It's really, that many years ago, it takes that long to get through these things. And so in fiscal year 20, the Waterfront received just over $19 million. And also, as mentioned previously in the presentation, the Airport Fund did recognize $4.5 million of CARES Act funding in fiscal year 20, with the remaining $5 million to be received in fiscal year 21. And so again, if you look at that in terms of the bottom line, the enterprise funds actually did manage to increase the net position by $35.5 million for a total of $450 million. Next slide, please. So now we're going to focus on the general fund. Next slide, please. Get into a little bit more detail of the specific funds. So the general fund has a fund balance. It's not the bottom line there. It's just up from the bottom right, a fund balance of $32.1 million. And that represents the difference between the assets and the liabilities. So it does sit with $42.2 million of assets, of which 24 million is cash or cash-like investments. And so at the end of the fiscal year, it was in pretty good condition, even though we saw significant reductions in revenues for the COVID pandemic, reflecting the prudent and conservative approach over many years from many previous councils and to firstly create and then hold accountable themselves to a reserve policy that is used and required in times of disaster. And so then the kind of the bottom right-hand quadrant here in terms of fund balances goes to show you that although there is a 32.1 million fund balance in total, there's actually a negative assigned amount, which basically is another way of thinking about unavailable reserves when we think about the policy that is set. Okay, because within that committed line is the council policy. It's an internally created requirement that council could change at any given Tuesday should they want to. That's why it's called committed and not restricted or non-spendable. Non-spendable and restricted have more of an external restriction on them. And so because we're supposed to have, according to council, a number of $34.5 million in reserve, but we don't, that's why you see the negative number in there of $5.7 million. Next slide, please. So how did we get there? Well, next slide, please. I want to talk about this slide reading from left to right first, and then in a second, I'm going to talk about it reading from top to bottom. And I've got a colleague calling me on the phone at the same time, which is helpful. So reading from left to right, we're looking at the actuals compared to budget. And so you can see that if we look at the revenue line, just above the first line, an adopted budget of 164 million, revised budget 174, and an actual of 157. We missed the revised revenue budget by $17 million. So that's consistent with what we shared with you at the fourth quarter. And that really does reflect the impact to the general fund of the COVID pandemic. Reading the next line across shows you that the expenditures were originally budgeted 165, revised budget's 168, and of course that includes carryovers of different things. But we actually did see significant savings of $8.2 million. And so when you add that all up, the adopted budget was a very close to a balanced budget. The revised budget showed an excess of revenue versus expenditures. And then in actual terms, we missed and had more expenditures versus revenue by $2.8 million, reflecting actually a $9.4 million adverse variance to budget. Next slide, please. When we think about fund balance, however, we want to read from top to bottom. The plan in many ways is irrelevant. The budget in many ways is irrelevant when you're talking about fund balance. The fund balance is basically the cumulative difference between your revenues and your expenditures. And so in the general fund, the expenditures of 159.9 million were 2.8 million higher than the revenues of 157 million. Therefore, the beginning fund balance of 34.9 million has to reduce down to 32.2 million. Next slide, please. What does that mean? Well, again, available reserves are relevant in terms of comparing to the council policy for 25% of future years' budgets. And we can see at the end of fiscal year 20, the disaster reserves per policy were fully funded. Contingency reserves, however, were significantly impacted, primarily because of the impact of the reduction in revenues received, although much of that was offset with significant savings in expenditures. Even so, the contingency reserves at the end of fiscal year 20 are about $5.3 million, reflecting $8.5 million less than policy. Next slide. So I am happy to pause there if you've got specific questions on general fund, Chair, or to carry on if you'd like me to carry on.
Let's go ahead and ask for questions right now. Council members, do you have any questions regarding the general fund portion of this?
No, thank you.
I had one, it's a clarification question, actually. It comes on page 13 of the CAFR. And I'm just trying to understand what GASB 68 means, because it says that, I'll just read what it says, and maybe you can, it caught my attention. It says, of the total net position, unrestricted funds had a deficit balance of 138.1 million due to the implementation of GASB 68. Before adjusting for GASB 68, unrestricted funds were 206.4 million, an increase of 23.3 million for the prior year. So I'm just trying to understand what is GASB 68 and what are is it an accounting thing or are there implications from it? If you could just clarify that
Yeah.
point.
Thank you, Chair. I'll do my best to give you the very abridged version of this. So GASB 68 is a pronouncement. GASB is the Government Accounting Standards Board, and they set the rules for how we have to report our financial information. And within the last decade, they issued GASB 68, which relates to pensions and the need for government agencies to report on the face of their financial statements the impact of any potential liabilities or, as is extremely rare, assets associated with the pension plans for their employees, both active and former. And so what that did when that was first introduced was put a significant tens or hundreds of millions of dollars of liabilities onto government balance sheets. And so because it's still relatively new, we include that language in the MD&A to kind of provide a like-for-like basis, because until GASB 68, those liabilities were not shown, and therefore it wasn't really reported as a net position. And so it's kind of like a like-for-like adjustment. So if we weren't required to do GASB 68, then we would be showing a different net position. But the net positions I've talked about and explained to you and are in the reports include the negative impact of the pension liability the city holds. I have some slides further on in the presentation that speak specifically to the pension liability, but that really is the reason for including that statement in the MD&A.
Thank you. This is an accounting for the pensions, so I appreciate that. Being that I don't see any of my other colleagues with questions, if you would continue on, Mr. Sewell.
Certainly, thank you. So I'm not going to go through every fund because there are over 80 of them, so you can imagine that will take quite a while. But I wanted to just pull out quickly the Measure C fund. So if we can go to the next slide, please. Wanted to remind again, for those people who are listening and interested, the Measure C fund is a separate fund from the general fund and any other fund indeed. The nexus to the general fund is that actually the taxation, the 1% additional tax that was agreed back in 2018, I think it was, when it first started, that does flow into the general fund and then flows straight out of the general fund into the Measure C fund without any additions or subtractions. And so we account for that completely separately. And as you can see, we then report a balance sheet and a statement of activities for that fund. It's now actually grown to be a major fund. There are criteria depending on the magnitude and size of certain things about whether something is classified as a major fund or a minor fund. So this is the first year now that it's a major fund. It does generate over $20 million in tax revenue, and therefore it quickly grows to that position. And what I wanted to show you here is just a change from prior year. The fund balance is very similar. It was last year 8.5 million, and now it's 8.8 million. The cash position has dropped a little bit from last year, but it still has $15 million in cash. And the reason why that's dropped is because of the activity that's actually been underway. And so if I can go to the next slide, please. This really, again, shows you in a dollars and cents standpoint of the activities that occurred in fiscal year 20 in terms of the areas of expense. And this is, again, just sort of a repetition of a report that you would have seen last week at Council and was more extensively shared with the Measure C Oversight Committee very recently by the Finance Department. And so this just confirms what we've been saying and was the intent, is that the revenue comes in through the general fund, and you can see that it was meant to be 23.1 million. It came in at 22.9, so very, very close. And council had adopted budgets for the different areas of expenditure there in terms of police, streets, facilities, and the fire department, parks and rec, and other public works. And then without sort of repeating the numbers into you, you can see that actual expenditures in the year were $22.7 million across all of those areas. And then that transfer out number there, that $5 million, just to share with you what that is the $5 million that council approved for Measure C to repay to the general fund that was loaned to the Measure C fund in a prior fiscal year for the completion of the Cabrillo Pavilion project. And so that represents a total $27.6 million expenditure in Measure C. And of course, we're seeing the benefits of that as we walk and drive and ride our bikes around town. And hopefully, once COVID is under more control, we'll be able to see the benefits to the wonderful Cabrillo Pavilion being open to the public as well. Next slide, please. a nexus to the Measure C, of course, and this is a required piece of information because for enable us to do the modified approach for city streets infrastructure, that again is an accounting thing. GASB have codified how and if we're allowed to do that. We need to have an average PCI, pavement condition index, of 60 or more. And so that's an independent scoring system that goes and takes account of the condition of our roads. And if we are able to demonstrate that that is 60 or higher, we do not have to, as accountants, try to capitalize and then depreciate and then deal with all the financial transactions necessary for our streets systems. So I'm very grateful as an accountant that we don't have to do that. And I'm also very grateful that we're seeing improvements in the condition of our road network. And this table here gives you the last few years an estimate of what it would cost to maintain it at the PCI rating for that particular year and what we actually have spent. And so you can see for a number of years, the city was spending a lot less than was actually required to maintain that PCI. And that's why the PCI was dropping. And the red line there shows where we dipped below 59. We actually received an audit finding for that because it was below 60. And as we know, around 2018 and 2017, I believe, was the year that the ballot measure was put on for Measure C. Streets infrastructure and infrastructure in general was one of the main drivers for the Measure C ballot measure, which passed. And so we've seen a significant uptick in the expenditures on pavement and roadways, and that's why we're seeing the corresponding increase in the PCI. Just as a piece of information, Public Works have looked at it and worked with their consultants, and they think it could be about $64 million over the next 5 years in order to try to get to the PCA target, which they've set, which is 70. And there's a lot of analysis and detail around why 70 is the target. Basically, the worse your road network, the higher cost it would be to try to maintain it. And so there's an optimum level to go for. And just to let you know and remind you that this current fiscal year, we've adopted $21.4 million for road maintenance, not all within Measure C. They are funded from various different funding sources. Some of it's grant funding, some of it's Measure C, some of it's streets capital. And so clearly the city continues to invest in its infrastructure. Next slide, please. Moving on then to enterprise funds. Next slide, please. A reminder, enterprise funds are those funds where they provide goods and services and they charge a fee for them on the basis that they're looking to recover their own costs. These are the enterprise funds that we have at the moment. And I want to just give you a table rather than sort of show you the many, many, many pages that are in the CAFA for all of the various, and the information's in there. And it's completely transparent. But I wanted to summarize it in the sense of where's the reserves for each of the enterprise funds at the end of the fiscal year. And put simply, the far right column there, if it's in brackets or parentheses, that means that they're below their policy level. And enterprise funds, like the general fund, have policy targets based on council's direction. And so they are required to have disaster and contingency funds and capital policies as well. And so while they have a significant fund balance of up to just over $500 million, the actual amount of available reserves, when you take into account the requirements, all of the fund balance that's restricted for fixed assets or for encumbrances or for other reasons, there's just under 10 million available. And you can see that water has 6 million of available reserves and wastewater is below the policy. Doesn't mean it doesn't have money. It just means it's below the policy, and sometimes that's planned and expected. And in the case of wastewater, it is. There was a decision taken to utilize reserves to fund its capital programming. And so therefore, it doesn't necessarily mean a good or a bad thing. It's just another thing to look at in the context. And so at the end of the fiscal year, remembering we had about 3.5 months of the COVID pandemic impact, there isn't an enterprise fund that's in a terrible financial condition at all. And all but 2 have available reserves. I wanted to mention one final thing on the Gulf Fund. It's there as a negative reserve. That's actually as close to being to its policy reserves in probably 15 years. And I think there's some confidence with Gulf being the silver lining in a very large cloud of the COVID pandemic. Gulf nationally has just exploded. And so I think there's some confidence that we might be able to report that as a favorable available balance going forward. And of course, Mr. DiMartini, as the finance director, will be coming back to Finance Committee and Council over the next few months to share how this might change in future. And Keith, I'd be happy to hand over to you if you wanted to speak more on the enterprise funds.
Sure. Thank you so much, Mr. Sewell. If I may, through the chair, I have a few additional comments I'd like to add on this slide. And just thinking about where we ended up on each of these funds as of the end of June 30th, 2020, and where we think these funds will be moving forward. As shown here, there is a substantial amount of activity in these funds. We deliver many services to the public through the enterprise activities. Just a couple of notes for the committee. It's really important to note that it's perfectly reasonable and expected that we should have a fairly high level of reserves in both water and wastewater. You know, the City Council has made a commitment to ensuring that the rates that we have for both the water and the wastewater enterprises are adequate and have increased over the past number of years, not only to pay for ongoing operating expenses to just maintain and operate the water and the wastewater systems, but to also ensure that we have the necessary capital to perform capital improvements. A lot of the system is aging, and it's important that we continue to use those ratepayer funds for capital investment. We have an opportunity here also to sort of revisit and relook at the way that we have historically been able to issue debt to sort of expedite and fast track some of the capital improvement projects, to maybe take advantage of some more favorable interest rates in the debt market to see what we might be able to deliver. So those are some things that staff might be looking at in our water and wastewater enterprises in particular. Downtown parking, there was an action at the City Council a few meetings ago in regards to the license plate reader project. That fund has been in trouble this year, primarily due to COVID and just less parking activity. And so the investment that the council approved of the license plate reader will be an initial investment, but is planned to bring that fund back into stability so that it doesn't have to dip into its reserves anymore. So that fund should see some reserve growth, hopefully in the coming year. Mr. Sewell already talked about the golf fund. The airport fund, we think will be okay as air traffic activity should resume once COVID sort of comes to some level. Again, the airport has been able to weather the storm this current fiscal year and the beginning part of the year through the FAA loan that we got through the CARES Act. So that has been able to sustain the operation during the year. And then finally, waterfront also has some challenges, primarily with the rent deferral program for many of the tenants that reside at the waterfront. Staff have been working very closely with those tenants so that we can ensure proper rental payment in the coming months. And so that fund has seen its challenges by the end of in this reporting period for June 30th, 2020. But again, staff anticipate that the activity will return to some level of normalcy in this current fiscal year. So with that, I do want to turn it back over to Mr. Sewell to sort of wrap up the remaining slides here.
Thank you. Yes, I will carry on. So next slide, please. So as Mr. DiMartini mentioned at the start, we look at the governmental funds, we look at the enterprise funds, and another subset of these different fund types are internal service funds. And these are funds where the majority of the work that they do is in support of either the governmental or the proprietary funds. And so a couple of the ones I want to just bring out for your attention are the self-insurance and the other post-employment benefit funds. Next slide, please. So self-insurance fund, this is where we account for risk, basically. The risk manager manages this fund, and it receives contributions from the enterprise funds and the governmental funds, including the general fund, on an annual basis as part of the annual budget to provide a pool for any claims the city may face or has faced. And as you can see, then it holds its own cash and assets and investments. Unfortunately, and this is where if I draw your attention to the third line from the bottom, unfortunately, those numbers being in parentheses means that it actually has a negative net position, which means it doesn't have as many assets as it needs to have in accordance with the actuarial reports that we are required to produce as a result of these types of operations. And so what that really means is that the current and anticipated costs for liability or workers' comp or all the other areas of risk that the city carries is in excess of the current assets. And so as a city, we're going to need to look at that through our budgeting processes and see how we can look to fund that maybe at a higher rate, or continue to do what we've been trying to do, which is obviously mitigate and reduce both the frequency and the magnitude of these claims to try to get this fund more into a balanced position. And so they're really the levers that are pulled. But according to the actuarial reports, as of reportable for the June 30th position, the self-insurance fund is currently in a negative 7.5 million position. The next column, the post-employment benefits fund, this is where we show in benefits that can be earned during employment that will then are received after the employee leaves, subject to certain eligibilities through their memorandum of understanding. And this excludes pension. This is not CalPERS. These are things like sick accruals that people can potentially cash out at the end of their service, and also retiree medical. And so with all things medical, we're seeing significant inflationary challenges and things like that. And that's where most of that $26.6 million number comes from. That again is the result of actuarial studies that look at our current employees and our former employees and take generally accepted estimates to work out the present value of all of the future benefit payments that a city is going to need to make on the expected number of people, et cetera, that are going to take up these benefits. And so the city doesn't have any assets in trust for this program and pays it on a pay-as-you-go basis. And so therefore, because there aren't any assets in trust, the fund looks completely underwater, $27 million. And again, that is the impact of the actuarial reports and the present value of all of those future benefits. Doesn't mean the city needs to pay out $27 million next year. It means that over the foreseeable, medium-term, long-term horizon, that's the value of assets the city would require to have in to be fully funded. And so, it's another area like pension, and I'll come on to pension in a minute, where we report a large unfunded liability, which has the impact of reducing the net position of the city. Next slide, please. Pension costs. Next slide, please. So pensions are an extremely complicated area, and we could probably spend many, many hours just on this one topic. But again, I wanted to just try to make sure we covered it, as succinctly as possible. And so there's a number of different factors in a pension, and there's a normal cost and there's an unfunded liability. And I want to just be clear on that. The normal cost is the rate at which we would need to provide funding to achieve a fully funded pension if all of the assumptions that the CalPERS and other agencies use were to actually come true. And typically that's about 10 to 12% of salary for miscellaneous and between 20 and 22 for safety employees. Next slide, please. The city does have an unfunded liability. It was mentioned when the chair asked about that adjustment on the MD&A. And what creates an unfunded liability is a negative actual versus the assumption that was put in place. So for example, CalPERS assumes a 7% return. If it's less than that, that creates an unfunded liability. If benefits are enhanced, that creates an unfunded liability. If wages increase higher than assumed, unfunded liability. And of course, if retirees live longer than are assumed, then that creates an unfunded liability. Next slide, please. So what can we do? Well, agencies and employees do contribute to the retirement benefits. So it's not just a city cost that the employees are paying as well. And what the city pays is a combination of the normal cost plus the unfunded liability, and that's what is paid out. And it's dependent on which plan the employee is in, again, miscellaneous, fire, or police, and whether they are a classic member or a PEPRA member. Next slide, please. So there's three charts on this slide. I'll talk about them pretty quickly. The pie chart I want to show you top left. The position of the net pension liability at the end of the year was $344 million. So that was the difference between all of the assets held in trust in CalPERS and the present value of the anticipated payments that would need to be made. And you can see just over half of that liability is the miscellaneous employees, and about a quarter each is the police and fire. The bar chart at the bottom left shows you how the funded status of those plans has changed over the last 3 years. And miscellaneous has become a little more funded, whereas police and fire have actually gone the other way. And we think that's probably most likely to do with the switch between more PEPRA employees than classics in the miscellaneous plan. And then the chart on the right-hand side shows you for the last 5 years, what's the value of all of the assets, what's the present value of all of the payments that are likely to be made, and therefore what is the difference? And the difference being the red bars, that represents the net pension liability. And so that's grown from 250 million back in 2016 to 344 million in 2020, even though the city has continued to contribute more each year. Next slide, please. And this is a representation of the unfunded liabilities. So this is quite a sobering chart. The green bars there show the history of what the city has paid just for the unfunded liability. So this is not the normal cost. This is the trying to catch up for all of the areas where the assumptions were more favorable than the reality turned out. And you can see that in FY20, there was just under $25 million paid as a UAL. We are required as part of our contract with CalPERS to make at least the payment for the unfunded liability that is shown on this chart before you. And so you can see for the next 5 years, the unfunded liability payment alone, this is on top of the normal cost, is going to grow to just, well, between $35 and $40 million in fiscal year 25. It drops down a little bit, but then starts to ramp up again going forward. And so you can see that the city has a significant amount of money to try to find to continue on this minimum required UAL payment for the foreseeable future. And with that, I'd like to move it on to the presentation for our auditors.
Good afternoon, Chair and members of the Finance Committee. I'm Nitin Patel, a partner with Clifton Larson Allen, and I'm here to give you a short summary of the audit requirements and results for the year ended June 30th, 2020. Next slide, please. Again, Clifton Larson Allen was engaged by the city to perform a financial audit and to assist the city in preparing the annual financial statements, also referred to as the comprehensive annual financial report. Our work this year was performed entirely remotely because of COVID, and we performed what we call our planning and interim work, where we test certain internal control processes in May, and our year-end audit started in October all the way through November, actually probably through December, until we issued the financial report. Next slide, please. The audit procedures performed. We planned and performed the audit to obtain reasonable assurance rather than absolute assurance whether the financial statements are free of material misstatement. Our audit included examining on a test basis evidence supporting the amounts and disclosures in the financial statements. As part of the audit, we also obtained an understanding of the city, its environment, including the internal control process it has for financial reporting, sufficient to assess the risk of material misstatements in the financial statements. Next slide, please. So the various reports we issued were the opinion on the financial statements, which starts with page 1 of the comprehensive annual financial report. We also have issued what's called a GAS letter, or a report on internal control over financial reporting and compliance, for an audit done in accordance with government audit standards. We did not have any material weaknesses noted in that letter, and there were no findings related to compliance. We also issued an agreed upon procedures on the city's calculation of the GAN appropriation limit. We issued a letter required with certain communications that are required to those in charge of governance, and there's really nothing significant to report on that. One of the items, we did not have any management letter comments or have any disagreements with management related to the report. And finally, we issued a housing successor compliance report required by SB 341. Next slide, please. So I'm going to cover what I think the city really wants to know about the audit. So the audit, again, was for the financial statements as of and for the year ended June 30th, 2020. In the opinion, we discussed that management is responsible for the preparation and fair presentation of these financial statements. The auditor is responsible for expressing opinions on the financial statements. The standards require, again, that auditors plan and perform to obtain reasonable assurance that the financial statements are free from material misstatements. The audit evidence we've obtained is sufficient and appropriate to provide a basis for our audit opinions, and we have issued unmodified opinions for June 30th, 2020. In other words, the financial statements are fairly presented in accordance with generally accepted accounting principles. Next slide, please. And I think that concludes my comments, and I'm going to turn it over to Mr. DiMartini.
Thank you very
Mr.
much. Mr. Patel.
Martini, I actually, we have the council meeting's coming up in about 10 minutes. So I know there's more to the report, but those are the appendixes. And so if it's okay with you, unless there's any vital information, I think we can follow up on our own on that. So is there any other critical information that you need to present, Mr. DiMartini?
No, Chair Friedman, this was the last slide we were going to present, which was just my wrap up. And then we were going to turn it over to questions.
Okay.
Okay.
Being that there is some timing issue, I think for right now we do need to take a vote on it, but we do have questions. I'm going to open up to questions from my colleagues, if there are any. And I don't see any. I don't have any further questions at this point. So what I'll do is open up to public comment on this. Is there any public comment?
Chair Friedman, I'm monitoring public comment. There are no hands raised.
Thank you, Mr. DiMartini. So if there is anything that you wanted to add in terms of the wrap up, or I think we do need to take a vote on this. So is there any last comments you have, Mr. DiMartini, before we take a vote?
Sure, I'll just say a few notes here. I know there was a lot of information covered. I do want to just reiterate what our audit partner said is the city received a clean audit for fiscal year 2020, just to make sure that that was very clear. It's a testament to the internal control framework that the city has been able to implement with all of our financial reporting and our transactions. We reported a strong net position for fiscal year ending 2020. It was clear there were impacts from COVID, and those were shown through many of the statements in the financial statements. So we will be able to monitor and report back to the committee and to the council on future changes related to COVID. We talked a lot about pension and OPEB liabilities, and we will have some significant challenges as a city with some decisions to grapple with. But we are committed to that, and we are doing everything we possibly can to ensure that we are paying our required pension costs as expeditiously and as possible, so that we take advantage of some prepayment opportunities. And we'll be pivoting into our upcoming budget cycle. So the information from the CAFR will flow into what we're doing in this current fiscal year, getting ready for our mid-year report in a couple months, and then our upcoming budget cycle for fiscal year 2022 and 23. And that was all, Committee Chair.
Thank you very much, Mr. DiMartini. I do want to thank staff for all your great work on this. This is a very time-intensive, labor-intensive document, and congratulations on the 32 years. And I'm sure we're going to get to 33. So with that, I know we're crunched for time on council here before we get to our council meeting. So is there a motion to approve the comprehensive annual financial report, or to accept it? See Councilmember Harmon.
Thank you, Chair Friedman, seconding or echoing his thanks, rather. I really appreciate all the hard work, and I will make the motion as Chair Friedman described.
And Councilmember Gutierrez.
I'll second it.
Okay, and there's a motion and a second to accept the comprehensive annual financial report. And may I get a roll call vote, please?
Yes, we had a motion to approve from Committee Member Harmon, and that was seconded by Committee Member Gutierrez, for the committee to accept the comprehensive annual financial report for fiscal year ending June 30th, 2020. We'll take a roll call. Committee Member Gutierrez.
Aye.
Committee Member Harmon.
Yes.
And Committee Chair Friedman.
Yes.
The motion passes unanimously.
Great. Well, thank you again, Mr. DiMartini and Mr. Sewell, and all of our staff that contributed to this, and our partners in the audit. So it's a really great document. There's a lot of great information. So I encourage members of the public to look at that. And you have everything from finances to what our pavement preservation index is. So again, thank you very much. And since there's nothing else on the agenda, this meeting of the Finance Committee is adjourned. Thank you.